All right, well, today is Wednesday, and we have had a bunch of phone calls so far this morning, just people asking a bunch of questions. So basically, what my goal is today is I have a lot of stuff I'm going to talk through, but first you're going to hear a couple phone calls from me. I'm going to call Wesley. I have a question about a pool.
Just getting off the phone with that client. Yeah, we're just trying to figure out everything else for this one, but just wanted more info on that pool thing. So what you're saying is the insurance companies won't even write a policy if you don't have the fence around the pool, like the good insurance agents, I guess, or the insurance brokers?
The question that is asked. So if there's like no fences, even on the perimeter, like I don't know how he decides the property line, but if there's a fence there, that technically counts. I just don't want somebody to essentially be able to pull up to the house, walk into the backyard, and just straight up walk into the pool.
So, little clarification from that conversation with Wesley, you can absolutely still get insurance if there's no fence around a pool. Basically, the insurance is going to be worried if there's no fence on the property. And usually it's not for California. California, most of us have fences. Other states, Tennessee, Missouri, a lot of the Midwest states don't have any fences. So that's kind of more what the rule is for, is if there's no fence at all on the property, it could be an issue getting insurance because basically if someone were to walking off the street and fall in your pool, you could be liable for it. Now moving on to our next thing, the Dream for All program, which is the real point of this video today. There's a lot of news, a lot of articles circulating around this program. So what I'm going to have you guys do is listen to a client consult that I have today with an actual client that's looking to use the Dream for All program, trying to figure out if it's going to make sense or not for them. You're looking at a $500,000 home right here, then you can borrow up to $100,000 of that, which is 20% of it. The way it works is you don't pay a mortgage on that. So basically, once you qualify for it, any amount you borrow, so you don't have to borrow the full 20%. 20% is the most you can borrow. You can borrow 5, you can borrow 10, you can borrow 15. That money of 20% of the purchase price comes to you and you can use it however you want. So it can go for the down payment, it can go for its closing costs. As long as it goes towards the purchase of the home, you can use that. And then basically as the home appreciates, you still owe that money back. And they take however much a percentage in shared appreciation. So if you borrow 20% up front, so right here it has the $500,000 home value, you borrow 20%, which is a $100,000 loan. And so you have a $400 loan from us, and then the $100,000 second that you borrowed, you're not paying monthly on the second. So it does kind of two main things. Number one, it's going to lower your mortgage payment because you're only paying on the first mortgage. You're not paying on the entire thing. And second, it could also, because of that reason, it's going to help you qualify for more of a house. So a lot of people that qualify for 400 without it will qualify for 500 with it, because the way that it uses it, you're not paying a monthly payment on it. And that's really what you qualify for when you're buying a home. So basically what it's showing here is that then the home appreciates, let's say 5 years later, it's worth 640,000. So the home appreciated 140 grand. So it was 500, now it's 640. So you still owe back the 100 you borrowed. And then you also owe back 20%, so percentage wise, of the appreciation. So 20% of the 140 is $28,000. So when you repay it, if you sold it 5 years later, right, you have what you currently paid back. So that's your mortgage balance. And then you have the actual loan that you pay back. So when you sell the home for 640, they're going to take back the 100 that you borrowed initially plus 20% of the appreciation to give you're paying back 128. So then you'd keep any other equity in it. Well, I would finish the day by saying we had a pretty productive day. I spent about 4 hours on the phone today. Got one offer accepted, one counter back, rate locked on the offer that's accepted, and one funding today. So overall solid day. Can't complain about it. It was awesome. Just, being able to help clients through that. A lot of questions, a lot of the nuanced questions that, a lot of times in this job, you have to find out random little details to see if something's going to work. Since we're a service job, the goal is to, do our best to make sure that people are getting the best options. Whether that's, we're helping them shop insurance, usually I use the people that I trust the most because I trust they're going to do a great job. As well as, making sure the best rate, making sure we're getting the best information up front. because a lot of people in this industry aren't honest up front. You know, they're wheeling and dealing to try to make a deal work, and they'll tell you something that's not true. So that's the goal. That's always the goal every day. Be straightforward about it. Try to make it work. Can't always be perfect. Mistakes will be made, but realistically, solid day today. Getting stuff done, getting rates locked, getting offers accepted, getting people into homes, and that's the goal.